India. It's one of the best places in the world to invest in. This is Investination India. It's your chance to learn why investing in India is a home run. You'll get actionable tips on how to invest, ways to invest, where you can invest, public and private markets, venture capital, private equity, angel investment, startups, and technology. There's a lot to cover, so let's do this. This is Investination India, and this is your host, Manish.
Hi, Vinayak. Thank you for being part of this podcast, Investination India. Why don't you give a little bit introduction about what you have been doing for past couple of decades?
Yeah, thanks, Manish. I run an investment company called Virtuous Capital Limited based out of India. We look to identify small corporates who are less than 10 million US dollar in revenue. So this was an opportunity which I could see some 2.5 decades back. In 99, I started a small investment company. It was a very difficult journey, good business to lose money. So after losing money, we learned to earn money, identify good corporates, good opportunity. And yes, this journey was amazing. So this is where we are.
So you identify these corporates. Are you some kind of a venture fund? What kind of investments you identify? Tell me a little bit more.
We never raised any sort of funds. This is a proprietary book for us. So in a small capital, when we started 23 years back, that capital grew to what we are today. And today we are 20 million US dollar fund. So we keep investing and we keep earning. So we never thought of raising any capital. We are not private equity fund. We have not raised any debt. So it's pure play, the accruals.
And what kind of companies you invest in?
See, we believed in a manufacturing sector and service sector related to manufacturing. Our understanding was very poor in software services. Equally poor understanding we had about startup ecosystem. So all along we graduated to identify corporates who predominantly earned some niche capability for themselves. What we understood is, okay, look, the large corporate, if they need to grow, they would need to have a large number of small corporates who could help them grow. And this is a space where we look to identify opportunities and stay invested.
I think you mentioned a very interesting point that when the large corporates are growing, they want to consolidate their vendors. Can you give me some kind of an example around it?
See, we recently stayed invested in an employee transportation company which caters to a software industry. If I give an example, Accenture India might be employing around 2 lakh employees in 30 different locations in India. They have today 100 million US dollar as an employee transportation budget, which say a decade back, it was probably 30 million US dollar budget, but they had 100 vendors to cater them. Today, with 100 million US dollar business, they have reduced the number of vendors to 25. Also, they are very clear. We don't want to have a large pool of our admin people monitoring this 25 vendors. We would want to bring down this 25 vendors to 7 or 10 vendors. So they don't have choice but to grow. And this is a lovely position for lot many. And it is a very difficult position to a few corporates. And you need to grow without choice.
How do you identify what companies you go after? There could be thousands and thousands of these companies in India.
According to government data, we have 64 million ultra small corporates. Out of those 64 million, we have 25,000 real gems available. These are the corporates who are 10 to 15 million US dollar revenue. They are top 3 or top 5 player in their own segment. And this 25,000 corporates are backbone of a large corporate. So out of this 25,000 corporates, we reach out to few hundred and end up getting few numbers to invest.
Are these companies looking for capital?
This is a sector which has gone through a much bigger grinding process. They would have started 3 decades back on an average with few thousand rupees as an capital. And today I can say 99% of their net worth is out of the accruals which they have earned. Our understanding is if we can make capital available to them, let us say 3 million US dollar, the base what they have created, they can double or triple the revenue. Your most difficult part is convincing them for capital raise.
Are there many people like you who are providing this capital? How do you get your exit?
3 years back, we used to invest only in those opportunities where exit is available strategically, where some large corporate within India or outside India will have an India entry. They will buy out my investment or they will buy out this company as a whole. So SME investment did not progress well in this country because exit was undefined. Opportunity for me was less. It really turned corner with the COVID period, SME stock exchange getting very, very active. So now exit is not a major headache for an investor like me.
So tell me a little bit about this SME exchange. What is difference? How it is different from the regular exchange?
2010, when government decided they need to float an SME platform, a minimum fundraise at that point of time for a large corporate were in a region of 30 to 40 million US dollar fundraise. So 30 to 40 million minimum fundraise and top 10 merchant banker having 90% market share, there was nothing available for SMEs. So government thought, can an SME raise $500,000 in a platform? Can it attract a very small cost to it? So that is what an intention of SME platform was. So like anything else, this platform also went through a grinding process. It had to fight for its existence, quality, scale, which all got created in last 3-4 years.
If I understand correctly, if there is a corporate which wants to raise lower amount of capital, $500,000 or $1 million, then a major exchange like NSE or BSE, that is not the place. What are the challenges? Why does it have to go to SME exchange?
Today, 90% of the main board IPO is consolidated within top 6 merchant banker. So when the consolidation happened, they themselves decided we would want to filter and render our services only to top corporates. So SMEs were left. I will add one more point over here. Most of the successful companies in main board, when they did their first IPO, they were all SMEs. And those SMEs did probably $5 million fundraise, but they started with that. And then they performed and raised multiple times the funds. And then they went on to become big and iconic company. Same thing is going through SME platform also.
If I understand correctly, is that NSE and BSE has become too big for these small companies to go and list themselves. And it is not just because of NSE and BSE restrictions, but it's also because the players who operate in that, they don't want to pick on these SMEs and list them onto main board because maybe the fees earning is not that big, or maybe their hands are too full to really devote any time and energy to this SME. Is that a fair point to make?
Very true.
So what is happening in this SME? Why during COVID times this suddenly picked up? Why we should look at SME exchange? Because there is so much of risk factor. So tell me a little bit about that.
See, risk factors are there in all sort of investment. The risk is equally there in main board also. Last decade, the history says 70% of the IPOs have not performed. 50% of the IPOs are below issue price. The risk could be slightly more in SME board because SMEs are by nature very fragile. Having said this, if we cherry pick those opportunities nicely, then losing money is very less percentage wise. If we keep in some filter check, are this SMEs significant player to their industry? Are they top 3? How significant they are to their ecosystem? How good is their financials? Are they debt ridden? If 5-6 points we properly check, then our job is done. 100% of the IPOs in main board are exit. Here 100% of the IPO is a growth capital for SME corporate. These two are major difference.
So what you're saying is that SME IPO provides a growth capital to the company, while in the case of a main board IPO, it's mostly existing investors are taking an exit. Here, the opportunity of growth is much high. Is that a fair assumption? Because I think both places the growth capital is being provided.
See, $1 is equal to $100 for SME. 99% of their net worth is accruals what they have. So imagine a company which is having $3 million as a net worth. It took 30 years for them to reach there. Imagine you are giving $3 million as a capital through stock market listing. So this company can easily triple the revenue. So the base is small and they're highly efficient. I'm not saying the large corporates are inefficient, but yes, the small SMEs are more cautious in spending. Their cost is less and they are in hyper growth mode.
I'm revisiting this point. This is an SME which nobody knows. And there is a company like Reliance or Paytm, which a lot of retail investors deal with day in and day out. Why should somebody not go with them and go with an SME?
Money would always chase where the growth is there. To a great extent, the bigger the company, the matured the market, smaller the company, the growth is abundantly available. I'll give an example. We found an Ayurveda company with probably $6-7 million revenue, never raised debt, never raised equity, and their growth was at 10%. We invested $500,000 in that particular company and we raised another $3 million in equity. So this company with $500,000 coming in from my side as an equity, this company started growing at 50% growth rate. It took 20 years for that corporate to raise $7 million. And with $3 million coming in, it is growing at 100% growth rate. So it's as simple as they need to have that equity for them to grow.
So a lot of retail investors are now investing into these SME companies.
See, I gave this answer slightly rude way. The main board corporates have not performed. 50% of the IPOs in last decade are yet to see their IPO price. There is where the retail investors started looking into this particular platform. Ki yes, chalo theek hai, because many corporates were humble enough not to expect a great valuation. They were all coming at 10 times, 7 times earning. When they saw money getting made, the interest with the retailers started growing. And we see 100 times, 200 times, 400 times subscriptions. That doesn't mean this platform is able to attract some great companies. No, it is still growing through a grinding process. Investors need to identify only those opportunities where it ticks all the boxes. If you need to earn money, you need to differentiate between HDFC and Yes Bank. So that job an investor need to do.
So tell me a little bit about the dynamics of SME exchange. How is it different from a normal main board exchange?
See, IPO or listing is all about compliances. Pre-listing, post-listing, during listing, there are liberty being given to a small corporate. Compliances remain same for both the platform. Real difference is the trading happens in lot size. In the main board, an IPO application can be made with $200. Against that, you need to have at least $1,500 as a minimum application in IPO. So here, there is a huge disadvantage for a small corporate to attract retail investor. Then post-listing in main board, the trading can happen in one shares. But here, the trading has to happen in that lot size. And the value-wise, stock exchange will quarterly maintain the value of that lot.
But then how will they get the return? That means that there is no liquidity in this exchange.
If you think of an investor, there are two kinds of investor. One investor is only for listing day gain or loss. And there is another category of investor he will stay invested for a minimum period of 3 years. He is able to attract those medium-term investors, and those medium-term investors are informed investors. They think the base of this company is small. Within 3 years, there could be a good amount of performance. So these are the two categories of investors who control the stock market for main board as well the SME board.
So if there is an investor and he invests into a company thinking that after 3 years the company is going to grow, but if there is no liquidity, he will not be able to get out.
What SME platform regulator has done, end of the second year, if your compliances are there and you have a 10 crore paid up capital, by default, you have eligibility to migrate in main board. So one of the reason kind of investor who will stay invested for a period of 3 years, end of the second year, on an average, 90% of the corporates have moved to main board. And that is what last 10 years history says. Out of 700 listed company in SME platform of both the stock exchanges put together, those who have passed this 2 years of eligibility with compliances, they all have migrated to main board.
And you can do it even before 2 years?
See, till date, stock exchanges have not taken liberty to do that. We would expect that depending upon company to company, performance to performance, the stock exchange will take liberty to migrate those companies at much earlier stage. That is to happen.
So if there is a good company in the SME exchange listed and it is growing well, and somebody can do the research, they can get a nice exit once it goes to the main board. Is that a fair assumption?
Good company in their existence in SME platform have rewarded investors like anything. The good company's definition is what? Someone who can grow 2 to 3 times. Can easily double the revenue and triple the profits. The base is small. That is why more and more investors are getting attracted over here. Our last IPO, we listed a specialty chemical company. First time we attracted FI in our IPO. We attracted mutual funds, the QIBs in our IPO. We never saw FIs investing. Rarely we see mutual funds investing. So yes, good companies are able to attract investor.
So for mutual funds, is there a restriction to invest into SME?
No, there are no legal restrictions for NRIs or FIs or DIs or mutual fund, but they have created the policy framework according to their risk. So broadly, they had defined some good corporate coming in, which ticks all their boxes. They are not no to those investments.
Let's say a company does not graduate to main board. How's the liquidity in the SME in that case? Would some investor get in liquidity in that case also?
I have come to a conclusion. There is no need to graduate to main board for a good corporate. We did a small fundraise of $500,000 exactly 18 months back for an engineering company, which in last 18 months doubled revenue and they have tripled their profit. And $500,000 fundraise has given 10 times to 15 times return to the investor.
Somebody who got the 10x return on that $500,000 investment, how were they able to realize that? Were there buyers available in the SME exchange?
Check BEW Engineering Limited. It is a leader in India in process equipment. Any chemical plant coming up in India, 90% chances is there BEW will have their equipment. We were invested in this company for last 7 years. And during COVID period, they were worried about their future. So they decided to do this. It was $500,000. And what was planned is $500,000. Can it make us eligible to borrow $1.5 million debt? So it becomes $2 million corpus. $2 million corpus coming in a company, we can double or triple our profitability. And 18 months down the line, they achieved it. That company, investors simply love that company and all have stayed invested and earned money. So if you can tick these 3 boxes, the growth in business, the growth in profitability, and the monopoly kind of situation, attracting mutual fund investor is not a problem at all.
And that provides a liquidity to the early stage investor.
Absolutely. If you are not able to tick boxes, these 3 boxes, then that particular script is highly illiquid in main board also. So out of 5,500 companies listed in main board, I would say 3,000 companies are illiquid. The trade would not be happening. So however small you may be, however small stock exchange you may be sitting, however limitation that stock exchange might be having, if you are a performing company, investor will identify you, investor will stay invested with you.
This is very helpful, Vinayak. Any risk factor?
I would say SMEs are much more fragile. They are very small. Investors needs to be very careful when they select the company, the industry. They need to read as much as possible, which is there in the DRHP, RHP.
Thank you. Any last parting words?
We are at a stage SMEs will make India proud.
Thank you, Vinayak. Thanks.
Great. Nice talking to you.
Nice talking to you.
You've been listening to Investination India. Manish has been a banker, having worked in India for the past 20 years, getting to know investors across the globe, encouraging them to invest in India. Having graduated from IIT Delhi and IIM Calcutta, Manish is the perfect person to learn to invest in India. We hope you've enjoyed the show. Make sure to like, rate, and review. Take care, and we'll see you next time on Investination India.